This is Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. The yen edges higher with Japan's ruling coalition set to lose its upper house majority after Sunday's election. Prime Minister Ishiba saying that he will stay on despite the historic setback. Investors weighing trade developments with the EU said to be preparing for a no-deal scenario. China's banks expected to hold their prime lending rates steady. Plus, Australia's Treasurer tells us drug subsidies are not up for negotiation as he evaluates the impact of potential 200% US tariffs.
Take a look at how we're setting up for the Asian market opens. We had 2 weeks of gains for Asian stocks, and you can see Nikkei futures right now gaining a little bit of ground. We had seen it gain 0.6%. Of course, this after the upper house elections. We've been watching the Japanese yen because hedge funds had flipped to bearish views ahead of the upper house elections. We have a little bit of a rebound in the overnight session. The Japanese yen about that 148 level against the US dollar. But what we'll be watching is the JGB yield space because we have seen yields at multi-year highs. Remember, these fiscal concerns about spending, and given the weakened position of Prime Minister Ishiba, we might see the government having to cooperate more with opposition parties in order to get their legislative agenda moving. And remember, opposition parties actually did quite well, those who were selling another sales tax cut. But take a look at how treasuries are also setting up, because we had seen U.S. stocks sort of wavering in the previous session. This, of course, as we are now seeing earnings season. Guys, if you flip up the board, you can see the treasuries will be watching after yields fell in the previous session. We had Fed Governor Christopher Waller talking about potentially another rate cut by the Fed. Of course, he's seen as a candidate for Fed chair after Powell. U.S. futures at the moment holding steady, but we'll be watching also oil prices. Brent very close to that $70 a barrel level. But it's really about the elections that we had this weekend here in Japan. Prime Minister Ishiba saying that he'll stay in office despite NHK reporting that his ruling coalition lost his upper house majority in Sunday's election. Now remember, this is the first time since 1955 that the Liberal Democratic Party will govern without control of both chambers. Let's bring in our North Asia Economics and Government editor, Yuko Takeo. Yuko, so if the results are in fact as polls had predicted, this is a particularly bad result for the Prime Minister. Can he still stay in power despite the fact that he's saying that he'll hang on?
Yes, Ishiba seems to have just missed securing a majority, so the results may be a little bit better than the polls initially predicted. But the bottom line is, as you say, he's lost control of the upper house, and this is a historic result because since 1955 that hasn't happened, two chambers being lost by the LDP. So Ishiba has already said multiple times last night that he'll stay on despite the result, which suggests for now he'll have to somehow cobble together enough support from opposition parties to pass the legislation on a case-by-case basis. That means he'll likely have to make concessions to opposition party demands, meaning more fiscal spending in some form is likely. But it's hard to see him staying too long. Every time a prime minister has lost this badly, they haven't stayed in power for so long. So we'd probably expect the LDP to ask Ishiba to leave in some form fairly soon.
How influential could the opposition parties be? Could they take over?
Technically, this is possible since they hold more seats than the ruling coalition, but it seems like a very remote possibility given those seats are split between a dozen or so parties that are very unlikely to be able to come together to form a government. It would probably make more sense for them to try and influence policy through the leverage they have over the ruling government for now and wait for whenever the next large election may be.
And all of this coming at a time, of course, when Japan is facing higher U.S. tariffs.
Yes, that's something that's been hanging over the election as well, and it remains unresolved. Japan is set to face across-the-board tariffs of 25% from August the 1st, barring a deal with the U.S., and so far there's been nothing concrete to show after Japan's chief trade negotiator, Akazawa, has been to the U.S. 7 times already. So now the ruling coalition will have to continue negotiations from a weaker domestic position with the deadline for higher tariffs coming up in about 10 days.
such a confluence of complications there going into this election. Bloomberg's North Asia Economics and Government Editor Yuko Takio there with us. Well, staying on the theme of trade risks, and European Union envoys are set to meet soon to formulate a plan for how they'll respond if the bloc cannot secure a US trade deal by President Trump's August 1st tariff deadline. From Wallace Breen, Senior Editor Wendy Benjaminson. And Wendy, we know a flurry of letters have gone out over the past few days. There's a lot of discussions and contemplation underway. Where do things stand when it comes to negotiations with the EU?
Well, they're going on, but they're not making a tremendous amount of progress, and that has led the EU to begin, as you have said, to create this no-deal scenario where nothing works out, and President Donald Trump does place 30% tariffs or higher on the EU, and then they have to figure out how they are going to retaliate, which they have to not only calculate how they will retaliate, but really still if they will retaliate, because any actions on their part could be met with reciprocal actions by the U.S. At least that is what the president has threatened. So right now, this morning in the U.S., the Commerce Secretary said that he was absolutely confident that there would be a deal with the EU, but the EU negotiators seem a little more worried.
What are the key sticking points at this moment?
The key sticking points in negotiations, it's hard to tell. It's really sort of up to Donald Trump and his mood and how he's feeling about them. I think the negotiations and the details that normally in past administrations we have always watched very carefully are not as germane this time because it just depends on whether they will agree to the 30% tariffs, and if they don't, they won't. But they are looking at sectoral tariffs on. They're trying to excise from the 30% tariffs sectoral items like steel, like aluminum, and in return, the EU could place higher taxes on American tech companies or, other actions like that could really cause a big mess.
What else are we looking out for at the start of this week, Wendy? We know that anything is really possible when it comes to the developments and headlines generated by the Trump administration.
That's absolutely right. Today, he has been celebrating the mark of 6 months into his term, and he's been sort of all over the map on things that he wants to do going forward. But he's really trying to shed the whole Jeffrey Epstein saga and move back into tariffs and trade, which are his favorite subjects. And he is heading to the UK, to Scotland at the end of the week. And so I think we'll probably start hearing a lot about tariffs as the week wears on.
Bloomberg Senior Editor Wendy Benjaminson there joining us from D.C. on the latest trade headlines. As we continue to watch the FX markets, of course, we have seen the dollar now seeing its best 2 weeks this year. On the other side of that trade, we had the yen pressured for the majority of last week. But in fact, in the overnight session, we saw a little bit of strength against the greenback as traders react to reports that Japan's ruling coalition will lose the majority in the upper house. For more, let's bring in Executive Editor for Asia Markets, Paul Dobson. And Paul, of course, we had expected this triple dip when it came to Japan, including when it comes to bonds and the Japanese yen as well. It seems that we have a little bit of strength, not a lot, on the Japanese yen. What's the trajectory from here?
Yeah, good morning, Shery. So really interesting. And I think that it's a bit of a watch and wait situation now for currency traders, for people in markets in general, to see exactly what form the new government or the government can take after this election. Ishiba is saying that he plans to stay on. Maybe the market takes that as a little bit of good news. Perhaps the party marginally performed better than might have been expected going into this. And yet, on the other hand, there's clearly going to be under pressure to do more in terms of fiscal stimulus. And that is what the market has been kind of nervous about. So what that actually looks like and how that plays out is going to be really important. And remember, parts of the market aren't even open today. What will be crucial will be how the Japanese government bond market reacts, and that won't give us a strong indication until tomorrow when trading resumes again. So you could say, is the yen up because of a little bit of a haven bid? Maybe. Is the yen up because of a little bit of a relief? Maybe. So it could be either way. Not entirely clear at this point, but either way, we do know that traders have flattened their positions a long way. So it may be that sort of neutral and slightly cautious approach that we get at the start of the week until we have a little bit more information here.
Speaking of caution, of course, we're watching the Fed as well. And as far as sort of the line when it comes to caution and patience for further easing that's still expected by the markets going into the end of this year, is the Fed becoming a little bit of an outlier among central banks?
The Fed is been sitting still for quite a long time now, while some of the other central banks have been cutting, as we know, and we've heard plenty about that from the US president, among others. It seems that at some point the Fed is going to start cutting interest rates again, but probably not this month. We've heard quite explicitly at the end of last week from Waller on the governing council sort of talking about how he's planning to vote for a cut this month, but that doesn't seem to be the consensus. We're still in that sort of watch and wait kind of scenario. Need a bit more information on what the tariffs does to the inflation outlook before more people are going to be comfortable voting for further cuts. And so into the second half of the year when we might see that. It's funny, isn't it? Because a lot of the other central banks, like the European Central Bank, has been cutting already through the first half of this year and is heading more towards a pause at some point by the sense of what we're hearing from policymakers there. So everybody's moving at slightly different paces at the moment, and that makes interesting opportunities, of course, if you're a currency trader looking for where the interest rate trajectory is going from here.
In the meantime, treasuries have already been pressured by abundant supply already. This notion of the Fed, perhaps its independence being threatened, how does that bode for the direction of yields?
Very difficult to read again, isn't it, Shery? It does feel like, I mean, the big, long kind of like consensus view at the moment is that US markets in general are over-owned by the rest of the world and that people are reducing their positions, be it in US equities or in US treasuries for that matter. It's only playing through very, very slowly, but that's why people continue to see this kind of gradual depreciation of the dollar over time as well. And what that's doing is pushing up yields, particularly at the back end of the treasury curve. And if you do have more of that challenge to the Fed's independence and more concerns about the investability of the US overall, then that's going to do more to push up those long-term yields, because that's where people will express the mistrust. And on top of that, if the Fed is being pressured to cut interest rates, all things being equal, and if Powell's going to be replaced by somebody much more dovish, you should see a much steeper yield curve as well. People betting that interest rates in the short term will fall, but that will probably push up inflation and add to those risks again for the back end of the yield curve for long-term bonds. And so you see that recalibration. That's the way that people are choosing to express it if they're anxious about the Fed independence at these times.
Bloomberg's Paul Dobson there with what we're watching. And coming up next, we'll be talking global trade with the Centre for Global Development. Later on, insights from the Eurasia Group. And Moody's Analytics joins us to talk about Prime Minister Ishiba's election setback in Japan. Much more ahead here on the Asia Trade. This is Bloomberg. Take a look at how we're setting up the start of a brand new trading week. A lot of event risk, of course, when it comes to what we're seeing in terms of Japanese assets, the faltering of the yen on political risk, some of the concerns over the loss of that ruling coalition majority as sort of projected as we went into Sunday's vote. But certainly that upper house majority potentially being lost raises the risk of further fiscal largesse, some of the complications when it comes to input from the opposition parties as well. Here in Australia, we're looking like a pretty downside day today, but of course on Friday we saw stocks extending that record rally there. Banks and financials advancing. We actually saw the biggest daily gain for the ASX 200 since April 10th. But of course, overlaying all of this are ongoing concerns about trade and tariff risks. Let's get some more when it comes to these ongoing tariff negotiations between the US and a fair few nations around the world. That August 1st deadline is ticking ever closer. Joining us now is Karen Mathiasen, who's a project director at the Centre for Global Development. Karen, really great to have you with us. And, as we speak, we're also hearing that European leaders and policymakers are sort of trying to come up with contingency plans if a deal is not struck by that new August 1st deadline. What are your expectations? Because certainly if you take a look at financial markets, that sort of perhaps complacency on the assumption that things will get worked out and President Trump will sort of seek some sort of compromise is still the prevailing narrative here.
Yeah, so thanks again for having me on. It continues to be fascinating times. I think the August 1 deadline is a bit of a puzzler because at this point there are 25 countries plus the EU in play. We know it's not realistic to have deals done with all of those countries. And at this point there are sort of only deals with three, the UK, Indonesia, Vietnam, and we don't really know what the details of those look like. So I think the real question for August 1 is how real a deadline is it? And will we see another kicking the can down the road situation? And even Trump himself has hinted that, it may not be a hard and fast deadline. So I think that makes it complicated for negotiators all over the world because they simply don't know how serious the deadline is, and for that reason, it's I think it must be quite tricky to figure out what an appropriate negotiating strategy is. I mean, in particular for some of the smaller, more vulnerable countries like Cambodia, your Laos, your Sri Lanka. Who are, not major trading partners, but for whom these tariffs could be quite devastating. So, again, just a lot of uncertainty, which seems to be the continued narrative here.
The strategy is an interesting one, right? As someone who's worked under Presidents Bush, Clinton and Obama, how sort of disincentivizing is it for negotiators in other countries when it's not just the deadline goalposts that keep shifting, it's also what's on the table, right? We know that President Trump is quite willing to throw everything on the table, including a lot of topics and issues that are not related to trade in terms of geopolitics or security.
Yeah, I think it must be quite disincentivizing for many of them. I think it's going to be much harder to basically make a case for providing a lot of concessions because you simply don't know what you're going to get in return, and if you have a deal 1 week, whether it will last. I could imagine with the other three countries, the UK, Vietnam, Indonesia, if any of there were developments in those countries that Trump was unhappy about, I could easily see him upending these deals, right? And so I think that's enormously problematic. I think as we're seeing in Brazil too, it can work. It can work the other way, where you see President Lula getting quite a bit of credibility and domestic support for resisting the sort of geopolitical nature of his tariff threat around Bolsonaro. So, I really think it must be quite brutal for a lot of tariff negotiators in these other markets.
So what's the point and the incentive for all of these trading partners to actually get to a deal? I mean, how easy is it for President Trump to tear down anything that has been agreed upon with other sectoral tariffs that could come later?
I mean, that is a great point. And I was going to flag that, since we last spoke, we've had the tariffs for aluminum and steel imposed, the threat of tariffs on copper. So you're absolutely right. You can have some sort of a deal on a country basis, but suddenly that could be undermined or offset by some sort of sectoral tariff. Because, the administration is working both angles at the same time. I mean, I think the incentive, of course, is to try to avoid the tariffs at all. And so I think you have to at least make an effort to show that you're negotiating in good faith, right? And I think Japan is a really good example of that. You had Besant over there at a very difficult time for Japan, as you just mentioned on your show. The Prime Minister has, lost control of the upper house, and at the same time, he's trying to negotiate a deal with a fairly unreliable partner. So I think it's got to be very hard. But I think you do have to show you're negotiating in good faith in an effort to at least, if not eliminate the risk, reduce it, or potentially again kick it down the road a bit. Try to postpone
on Japan
the decisions. Yeah.
Given that the auto sector is such a sticking point between the two sides, how do you see this actually getting to a breakthrough, and what's next?
Well, I think that what we have to remember is the extent to which the relationship is mutually dependent, right? And we saw this with China. And as there was this escalation towards an absolutely brutal trade war, both parties eventually did back down as it became clearer and clearer just how devastating the impact could be on both economies. And I think that will happen with Japan as well. And I think what you can't discount is what is happening behind the scenes in the United States. We do not know, what is going on at the White House, but I think it is safe to assume that you have a lot of panic calls from a lot of very powerful CEOs who are really spelling out for the president just how devastating the impact could be on manufacturing, on jobs, and these are things that he really cares about. So I think that's that unknown, the known unknown that we're dealing with will help to bring this to some kind of a resolution.
Karen Mathiasen, always good to have you with us, Project Director at the Center for Global Development. We have more ahead on the Asia trade. This is Bloomberg.
Some of the other stories we're following this hour, and Ukrainian President Volodymyr Zelensky says his government has proposed a meeting with Russia next week, more than a month after a previous round of direct talks. Zelensky says the Russian side should stop hiding from making decisions. A Kremlin spokesman, meanwhile, says a meeting between Presidents Putin and Trump will definitely happen, but that so far the right time has not come. Iranian media reports say agreements have been reached for talks on its nuclear program with the UK, France and Germany. A state-run agency says the talks planned for Friday will be at Deputy Foreign Minister level. It says the discussions will be separate from indirect talks with the US, which has stalled since Israel launched attacks on Iran in June. Presidents Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit beginning at the end of October in South Korea. The South China Morning Post cites sources saying that Trump could make a stop in China on his way, or they could meet on the summit sidelines. Sources have told Bloomberg that Trump has been dialing down his confrontational tone with China in hopes of securing a summit. Much more ahead here on the Asia Trade. This is Bloomberg.
Private sector is not doing as well as everybody thinks it is. Like most of half of the employment growth we saw last month was in the public sector, and that means the private sector is not doing particularly well. So I was just joking that, if you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice.
Federal Reserve Governor Christopher Waller there citing concerns over hiring in the private sector after calling for the bank to cut rates this month. We actually saw Treasury yields falling on those comments last week. Remember, we have seen, of course, yields pressured higher given concerns about spending and the fiscal picture in the United States. But we had seen that pressure on yields last week with the Fed governor calling for a cut in July. And this, of course, as is seen as the contender for the next fair chair position if Powell is dismissed. We have seen already June CPI and PPI surprisingly soft in the United States last week, although U.S. consumer sentiment did rise to a 5-month high. We'll be watching existing home sales and new home sales data this week out of the U.S. Haidi.
Take a look at what we're watching here in Australia when it comes to the setup for the session. And as you mentioned, sort of some of these tariff concerns also weighing on Australia, given the exposure that certain sectors have here. But Sydney futures looking a little bit softer today. We had the extension of that record rally on Friday, though largely led by financials and banks. We are seeing a little bit of a pullback there, perhaps some profit taking at the start of this week. The Aussie dollar, though, still on fairly firm footing at 65.10. The sort of ongoing China truce, the potential of that summit between President Xi and Trump driving a little bit more optimism in this proxy risk currency. Australian Treasurer Jim Chalmers says there's no chance that his country's subsidies when it comes to certain drugs are up for negotiation as officials evaluate President Trump's threatened potential 200% tariffs on pharmaceutical imports. Chalmers spoke with Bloomberg from the G20 meetings in South Africa.
Well, Australia has the baseline tariff, the 10%, and some additional areas like steel and aluminium, copper, pharmaceuticals. And so we're engaging with our counterparts in the US, like almost every other country is in the world. We're pretty well placed and we're well prepared to deal with these tariffs. The direct impact is relatively manageable. Our bigger concern is the impact on global demand of all of this uncertainty and volatility and unpredictability, which puts global growth and indeed global inflation at risk. And so in our modelling, the bigger risk comes from the impact on the global economy rather than the direct impact.
Okay, because 10% is basically, as far as we can tell, the lowest possible deal. That's effectively what you will have with the United States. Are you happy with that, and does that warrant retaliation or no?
We've decided to go for resilience in our own economy rather than retaliation. You know, the 10% tariff is the lowest of any countries, but you know, we've made it really clear that we think the appropriate tariff consistent with our trade agreement is zero. We see these tariffs as self-defeating. We see them as an act of economic self-harm. We've made that very clear. Bad for the US economy, bad for the global economy, and therefore not good for Australia.
Do you see any progress possible on steel and aluminum?
Well, it remains to be seen. I mean, we've been engaged more or less constantly for some months now, whether it's steel and aluminium or some of the more recent announcements around copper and pharmaceuticals. Our approach is to engage at every level as much as we can to get a better deal for our workers and our industries, our exporters, our and our investors. And that approach will continue to guide us.
And in terms of the negotiations around pharma, we've heard 200% as a possible figure from the United States. Are changes to Australia's pharmaceutical benefits scheme, is that something that's on the table because the Trump administration has been very focused on non-tariff barriers? Is that part of the conversation?
Absolutely zero chance. We couldn't be clearer. Our pharmaceutical benefits scheme is a crucial part of our architecture, our policy architecture. It's something we're very proud of. We've made it really clear that we're not prepared to negotiate or diminish or weaken the PBS in order to get a deal. We've been clear about that from the beginning. We're working through the potential consequences of pharmaceuticals being caught up in these escalating trade tensions. We do have quite a substantial export offering into the US when it comes to pharmaceuticals. But how this potential tariff might work, we're working through with the industry and with the administration.
There's been a huge amount of pressure from the United States for allies to spend more on defense. You saw that most concretely in NATO a couple of weeks ago, where you had that boost in pledges for 3.5% effectively of defense. Do you think Australia could get to that figure of 3.5%? Do you think that would be appropriate to join sort of allies at that level?
Well, first of all, it is a big part of the conversation here, particularly with European friends, how they'll find the 3.5% of GDP and how they'll account for the other 1.5% of GDP for national security related spending. For Australia, we're already by our standards, quite dramatically escalating our defence spending. You know, we're taking it from 2% of GDP up to 2.3 at the start of the next decade. That already represents, you know, tens of billions of dollars in extra investment. It's a much higher trajectory than when we came to office 3 years ago. And so we are increasing our defence spending. We make those decisions, trading them off against all kinds of other budget priorities. But we say to American friends and we say to the world more broadly, we are already increasing our defence spending because we think it's important at a time where we are seeing this heightened uncertainty in the world.
Mm-hmm. Australian Treasurer Jim Chalmers there speaking with our colleague Oliver Crook. Well, of course, we know that China is tightening controls on critical mineral exports, pledging zero tolerance for smuggling and illegal shipments. State broadcaster CCTV says Beijing's Export Control Office flagged recent cases involving false declarations and transshipments through third countries. China is enforcing stricter licensing for all rare earth shipments amid ongoing trade tensions with the US. Well, Myanmar is the world's third largest source of rare earths after China and the US, but nearly all of its mines are in the state of Kachin, which is clustered around an area controlled by a rebel army. For more on this, Bloomberg Big Take Business Week Asia editor Matthew Campbell joins us now for more on this sort of renewed focus on which nations has potential supply of these critical minerals has really kind of taken headlines since this trade war, right? When it comes to the rebel army in Myanmar, how does this fit in with it being a key rare earths player?
Well, Myanmar, as you said, is the world's third largest rare earth producer. That does put it quite a ways behind China and the United States, but significant nonetheless. And it turns out that since last year, the vast majority of Myanmar's supply have been controlled by this fairly obscure rebel group, the Kachin Independence Army, who are now sitting on something like 50% of the global supply of two particularly important rare earths, terbium and dysprosium. And what they intend to do with this haul, these riches, is a bit of a mystery.
Do they have a relationship with China at least?
Yes, they do. So the Kachin Independence Army, the KIA, or the KIO is their political arm, have a very complicated relationship with China. The Chinese government, so far as we can tell, are not terribly close friends of the KIA because the KIA, of course, fight the Myanmar junta, who are a key partner for China. However, these rare earths do go over the border from Kachin, from KIA-controlled territory in Kachin, into China, where they are processed in Chinese plants. So for the moment, these supplies do flow into the Chinese supply chain and are then subject to whatever export controls China may want to impose on them.
So there's obviously no refining capacity there, hence why it's going to China. How are they mining these rare earths? And, you know, as you say, even if they're a far third behind China and the US, is there any sort of leverage or usefulness that they're making out of this?
I think in principle, anyone with a significant supply of rare earths at this point has significant leverage. So one thing we point out in the story is that Greenland, which President Trump has said he covets for its rare earth supplies, has zero active rare earth mines. Kachin, this region of Myanmar, has hundreds of active rare earth mines. So it is very significant. The question of what leverage they have, we don't really know yet specifically because there are no alternative export routes for the moment from Kachin, but there could be in the future. And that then puts this organization, the KIA/KIO, in a very interesting position. The extraction, which you asked about, is a dirty and dangerous business. There is a process called in situ leaching, which is employed in this part of the world, which we don't need to go into all the details, but suffice to say is very polluting, very dangerous, exposes workers to potentially a great deal of harm. But the KIA do not seem terribly concerned about that at this point.
What does that mean for Myanmar itself? Of course, we know that this is a country that's not necessarily been able to control all of its territory during its history. So do we have any idea right now what will happen to these new riches coming from rare earths?
For the moment, the KIA are firmly in control of this remote part of Myanmar. The central government, the junta, as we often call it, have been kicked out pretty comprehensively, and the prospects of them retaking it are somewhat remote. So this is going to be another example of where Myanmar ends up looking like a Swiss cheese with these ethnic militias of various kinds carving out territories. Some more organized, some more permanent than others. In this case, it is a territory that came with an incredible mineral endowment, which will be enriching the KIA for the foreseeable future.
Bloomberg Businessweek Asia editor Matthew Campbell there with the latest on Myanmar and rare earths. Take a look at some of the other commodities that we're following at the moment. Oil is sort of holding steady, but very close to that $70 a barrel level for Brent. And this, of course, after we continue to see the latest progress on trade negotiations. We've seen a weekly drop this month already for oil prices, a trade deal progress, and the European Union's efforts to curb Russian energy exports in focus. We've been also following the price of gold. It gained in the previous session after we saw the Fed Governor Christopher Waller hinting that he could dissent potentially from his colleagues at the FOMC when it comes to holding rates steady at their July meeting. He's called out for a rate cut given the state of the U.S. economy. Iron ore, of course, will be following the Chinese economy. We do get those loan prime rates today and a hold expected for this decision, with China's commercial banks likely to keep rates unchanged for a second month. We have more ahead. This is Bloomberg. Take a look at how the yen is trading. Of course, we have seen significant pressure on the Japanese currency in the last few weeks, especially as hedge funds turned bearish when it comes to the Japanese yen ahead of the upper house elections. We've seen a little bit of strength in the overnight session. This, of course, as we got the results of the upper house election to be announced and confirmed later today. But so far, polls showing that the Prime Minister Ishiba's government might have lost the upper house majority, and of course, the implications of that, especially for the JGB space, as there have been fiscal concerns in this country, will be crucial. Markets closed today on holiday, so we'll see the resumption of stock and bond market trading on Tuesday. But let's bring in David Boling, Director of Japan and Asian Trade at the Eurasia Group. He previously served at the Office of the U.S. Trade Representative, where he helped negotiate deals with Japan. It's great to have you with us. You've been here already for a month, taking a look at the campaign season and how this upper house election has unfolded. I mean, are we expecting Prime Minister Ishiba to resign despite the fact that he says that he'll stay on given the results?
Good morning. Yes, great to be here. And I think the big message from this election has been, inflation, and it kills incumbents. And we saw that happen in last October in the election, and this is sort of the second punch that Ishiba has taken. I think it's very hard. He was already on shaky ground. He's even on more shaky ground to remain as prime minister. He's vowed to do so. We'll see what he says at his press conference today. But, Taro Aso, very influential member, former prime minister, has already said that he wants to push him out. So I think there's going to be, the knives are coming out, and we'll just have to see if he can hang on. It's not going to be easy.
When we talk about shaky ground, when we talk about this political battle within the government, that just means that the agenda of the government will not be able to be moved forward, right? At a time when Japan is also facing U.S. tariffs, how problematic is this?
I mean, it's difficult. Again, Ishiba was already in a weak position. This is not Abe. When Abe was negotiating with Trump, he was negotiating from a position of power. He controlled both houses, had strong majorities, so he could talk to Trump and make concessions on agriculture. I mean, Ishiba wasn't in that position even before this election, right? And he was having to deal with sensitive issues like rice and automobiles. He was in no position whatsoever to be able to make concessions. Now you think about, well, he doesn't have an upper house majority, doesn't have a lower house majority. How's he going to push this thing through if he has to get a deal? How's he really going to push it through?
So the lame duck gets even lamer.
It's a good way to say it, Haidi.
So what does that mean for the, I guess, the tenor of these trade negotiations, right? Obviously not a great deal of leverage if there's some degree of political uncertainty or even chaos going forward.
Yeah, I mean, in one sense, it doesn't change the dynamic a whole lot. I mean, we saw Japan was a priority country for the Trump administration early on. I think it's lost that status. I think that Trump now looks at Japan, honestly, like dozens of other countries. And the letter that he sent to Prime Minister Ishiba shows that. I don't think you see that letter come from President Trump to Prime Minister Abe. So I think that gives you a pretty good sense of where Japan is in the pecking order right now. And also we have to remember, I mean, Trump is tariff man, right? And so if at the end of the day, the negotiations produce higher tariffs on Japan and higher tariffs on many other countries, that is not necessarily a bad outcome in Trump's mind.
We talked a little bit about the fragmentation of the Abe faction 3 years after his death. Is there a kingmaker adjacent at this point? We've talked a little bit about Taro Aso. He's obviously a heavyweight. Who do you see as being pushed forward as alternatives for the leadership?
Well, I mean, obviously, Koizumi Shinjiro is going to be a leading contender if Ishiba steps down, and then Takaichi Sanai. And I would say Takaichi Sanai is the most Abe-like when it comes to her positions. You know, she still supports Abenomics, even though it's probably not really suited for the economy right now. And, you know, she's been very tough on the Bank of Japan. She said raising interest rates is stupid. So I think she probably would be the one that the conservatives would most be attracted to. But her problem is, just as you said, the Abe faction is disintegrated. It's gone away. And where's her base? That was her base. And many of the candidates she supported last October lost. So the challenge for her is, you know, basically, where is her base now in the LDP that could push her to victory?
When it comes to the Japanese economy, we have seen these parties that actually advocated for sales tax cuts doing pretty well in this election. Are we headed that way, given that the LDP will need to make concessions?
I mean, I think the LDP's got a fight on its hands, right? I mean, the LDP has been trying to position itself as the party of fiscal responsibility. And so I understand why they took that position in the election. But every one of the opposition parties was advocating either to abolish the consumption tax or to gradually eliminate it or some sort of version to lower the consumption tax. And so I think it's going to be difficult for the LDP to keep that from happening. I think the Ministry of Finance is going to fight this to the death because they want to keep that consumption tax. And so in the end, I think they will probably have to compromise, but it's going to be a fight, and LDP and Ministry of Finance are going to try to limit the cut as much as possible.
Which eventually complicates the picture for the Bank of Japan and just the broader economy.
Bingo. I mean, the Bank of Japan already in a very delicate position because of not knowing the tariff issue and when it would be resolved. Now it has to deal with the fiscal picture, which looks like, you know, it could become more complicated. So the Bank of Japan has a very tough job right now.
Well, are we at debt of 240% of GDP or something here in Japan? David Boling, good to have you with us, Director of Japan and Asian Trade at Eurasia Group. And of course, you can catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, subscribers can also watch live on the terminal using the TV Go function. More ahead. This is Bloomberg.
Well, it's been a milestone couple of days for TSMC. Of course, we saw the stock closing at a record high in Taiwan, the market cap topping $1 trillion as of the Friday close, and in fact, matching Berkshire Hathaway in terms of market cap, entering that top 10 list globally. It is by far the heaviest weighted stock on the MSCI APAC, more than double the weighting of the second heaviest, which is Tencent. But TSMC has cited FX volatility as a major source of uncertainty going forward, affecting its profit margins. Comes after the Taiwanese dollar surged nearly 11% this year against the US dollar. CFO Wendell Huang told us exclusively that the chipmaker is constantly reviewing hedging strategies.
We don't predict the Taiwan dollar would we simply described the potential impact to us. And as I said, there are 6 factors affecting the profitabilities. Foreign exchange rate is something that we cannot control. But there were such instances before where the foreign exchange rate was not in our favor. But we managed to lean on other factors so that we are able to keep our profitability. And that's what we are planning to do.
Do you have contingency plans in place for a more rapid appreciation of the Taiwan dollar?
It goes back to what impact our profitabilities. So there are the factors that we're able to control. We will definitely work hard on those factors to maintain the profitability. We use different hedging alternatives. The first one is to just simply sell the US dollar in the market, spot market. And we also use forward contract. And we also move part of the cash, the US dollar cash, to a offshore holding company, which the financial statements are denominated in US dollar, not in NT. So that saves our hedging cost.
Which tool your priority, or is your priority?
It's a combination. At the same time, you want to sell the spot, which is the easiest one. But there is market appetite to consider. So you go to the forward contracts, still there's also market appetite and cost, and hedging cost. And then we've been using this capital injection to the offshore company for years. So there's a combination, and we will use those combinations.
TSMC CFO Wendell Huang speaking exclusively with Bloomberg's Annabelle Jewelers. Take a look at how the Japanese yen is trading. We have seen significant pressure on the Japanese currency, but we're seeing a little bit of a rebound in today's session. Of course, we just are getting the picture of the upper house elections on the weekend. The ruling coalition is expected to have suffered a historic setback, with its partner losing its majority in the chamber. We're also getting the latest when it comes to trade negotiations with the United States, and we're hearing that the chief negotiator will be headed to Washington next week. The market opens in Sydney and Seoul are next. This is the Asia Trade. We're counting down to Asia's major market opens. Japan, though, away on holidays. Heidi, we're following the Japanese yen after we're now expecting the ruling coalition to lose its majority in the upper house. What that means for Prime Minister Ishiba, that's, of course, just negotiating this trade agreement with the U.S. will be key. Really, trade headlines top of mind this week as well.
Yeah, for the EU as well, right? We're hearing that officials there are preparing some sort of retaliatory plan in case this August 1st deadline cannot be met with the deal there. But as you said it, Shery, it makes things very difficult. And it was difficult going into the upper house election. But now, for any kind of progress to be made when it comes to Japan and the US.
Especially given that the Liberal Democratic Party may have to make some concessions to the opposition parties, and what that means not only for trade negotiations, but also for, of course, the Japanese government bond space that has already been really concerned about the fiscal picture here in Japan is a key question. We have seen yields at 2-decade highs. What that trajectory of JGBs will be going forward, a key question for investors as we're watching the Japanese yen, which is now rebounding slightly towards that 148 level against the US dollar. Of course, we have already seen significant pressure on the Japanese yen in the last couple of weeks, with hedge funds turning bearish on the Japanese currency ahead of the upper house elections. We're following South Korea as well. We're now getting the first 20 days of trade. That data for the month of July, we saw exports now falling 2.2% year-on-year. Imports also falling 4.3% year-on-year. That leaves a surplus for trade at $465 million, a key figure, of course, as we continue to follow the South Korean economy and its own negotiations with the U.S. A 25% tariff expected on August 1st. If that deal is not reached, not a lot happening in the stock space. The Korean won also holding at that 13.91 level, Haidi.
Take a look, Shery, at what we're watching when it comes to the setup in Australia. A little bit of a breather, perhaps, when it comes to stock investors, given that we had the extension of that record rally just in that Friday session, off by just about 0.5%. We heard some of the comments from Treasurer Jim Chalmers about the drug subsidies issue, given that there are these fears still that even if these pharmaceutical tariffs start off low, as President Trump has hinted, they could go towards that 200%, which is flagged within a year or so. So we are seeing quite a bit of resilience when it comes to the Aussie dollar, trading at 65.11, and of course a proxy for what's going on in China as well. We're expecting that loan rate to be held steady today. Watching treasuries as well, given that it's not just a JGB story, that we have seen that broader pressure when it comes to the long end of yields. Our next guest says signs of market complacency towards tariff risks is a worrying development. David Chao is a global market strategist for Asia Pacific at Invesco, joining us from Singapore. And David, we've heard sort of a chorus of voices warning about this complacency, right? But at the same time, we continue to see really market participants shrugging off the worst case scenario. Do you think it's a worrisome narrative that the taco trade will sort of prevail, that the compromise will be reached and things won't be as bad as at least when the tariffs were initially first flagged?
Well, I think that it depends on what kind of investor you are. I think that bond investors certainly appear to be a lot more concerned than equity investors, and I'm perhaps more on the bond investor side. I think that we're a bit whistling past the graveyard here when it comes to tariff risks. It's very apparent to me that the Trump administration continues to want to use tariffs in its toolkit when looking at global trade. Ultimately, we have to remember, though, that tariffs are just a near-term phenomenon, and that we have to look at what the fundamentals for the American economy, for the global economy, are going to look like for the remainder of the year after we get through this tariff phase.
And how do the fundamentals look like, and how do they sort of inspire you to invest at this point?
I think that the fundamentals around the world look pretty strong. We're continuing to move through a phase of uncertainty, which could cause growth to be below trend. But I think that with central banks around the world, especially in the APAC region, cutting rates, they do provide a bit of a floor for growth and also for markets. So I take a more sanguine view of growth outside the U.S. And also I think that markets outside the U.S. look a lot more attractive.
Is a floor for the Japanese market the fact that we might get more fiscal spending, given that the central bank is actually going in the opposite direction and trying to hike rates?
Well, I think that all eyes are still on how the composition of the Japanese government is going to be formed going forward. And we could be in a very short phase where there is a bit of political uncertainties. But ultimately, the results of the election were largely expected by the markets. And I think all eyes are very much on the trade deal now between Japan and the U.S. And we got some optimistic comments coming out of leaders that a trade deal can be inked very soon.
Where is the Japanese yen headed? I mean, we've been talking about strength for a while now, but we're now at 148 and continuing to weaken.
I think that very much depends on the direction of the U.S. dollar. And I think that this recent strength of dollar is just a dead cat bounce. I think it's likely to reverse action and reverse course. I think that dollar is likely to weaken, and that means that that gives a chance for the Japanese yen to strengthen. And we continue to expect a tightening monetary policy in Japan in order to counter some of the inflationary effects that we've seen for a while. So I think that the Japanese yen continues to be a very attractive currency. We think that it's going to be perhaps one of the best performing currencies in the next 12 months.
Talking about best performing, we saw the Hang Seng Index in the previous session reach levels that we haven't seen in about 3 years or so. Is there more room for upside given the valuation levels at this point, or is this a one-off?
I think that there's more room for Hong Kong stocks to run. And we have to remember that the first place that foreign investors look at when investing in China, they go into Hong Kong stocks. They go into large cap, internet, stocks on Hong Kong. And I think that when you look at valuations, Chinese tech stocks listed on Hong Kong trade at a steep valuation discount to their American peers. And so I think that there is still room for Hong Kong stocks to run, for Chinese tech stocks to run. And that's going to be a very important investment theme that we'll look at, especially once we get through these tariff uncertainties.
Yeah, I was going to ask, is that sort of agnostic to whether this trade truce holds or not?
Well, we continue to be in an environment where there's trade escalation and de-escalation, but I would say that we're through the peak tariff uncertainties, and we're looking at deals now. And secretly, we've had a few deals that were announced already, especially in Asia, and I continue to expect that going forward. Tariff deals, when they're announced, are better for markets in Asia, for the countries that the deals are announced in. And so it's possible that we get some deals announced in India, in Japan, and other places in Asia that could provide a boost for Asian markets in the coming weeks.
David, really great to have you with us. David Chao, Global Market Strategist for Asia Pacific at Invesco. One of the stocks that we're watching when it comes to trading in Australia, South 32, we had alumina production coming in basically in line with expectations, and we're seeing a little bit of upside there of 1.7%. More ahead on the Asia trade. This is Bloomberg.
Japan's Prime Minister Ishiba says he'll stay in office despite NHK reporting that his ruling coalition lost its upper house majority in Sunday's election. This marks the first time since 1955 that the Liberal Democratic Party will govern without control of both chambers. Let's bring in our North Asia economics and government editor Yuko Takeo. And Yuko, I guess the question is how long can he stay in office for, given that this is not his first dismal election and the last, 3 LDP prime ministers who lost the majority in the upper house actually had to step down later.
Yes, Ishiba seems to have just missed securing a majority, so the results may be a little bit better than the polls initially predicted. But the bottom line is, as you say, he's lost control of the upper house, which is a very historical result. Ishiba's already said multiple times last night that he'll stay on despite the result, which suggests he'll somehow have to cobble together enough support from opposition parties for now to pass legislation on an issue-by-issue basis. But that means he'll likely have to make concessions to opposition party demands, meaning more fiscal spending in some form is likely. But given the historic nature of the loss, it seems difficult to see Ishiba remaining in power for much longer, given the precedent that all 3 prime ministers who lost control of the upper house left within 2 months. It seems hard to see Ishiba as breaking from that mold.
How much influence will opposition parties have from here on in?
Technically, they could take the government. It is technically possible since they hold more seats than the ruling coalition. But it seems like a very remote possibility given those seats are split between a dozen or so parties that are very unlikely to be able to come together to form a government. It will probably make more sense for them to try and influence policy through the leverage they have over the ruling government, as the LDP struggles through for now, and for them to wait for the next general election to try and consolidate more power.
unstable leadership here in Japan will not help with trade negotiations with the United States. But at least we're hearing that the top negotiator could be headed to Washington this week.
Yes, that's what we're hearing so far. But Akazawa has been to Washington already 7 times with very little to show for it. And this whole issue of tariffs likely rising to 25% on August 1st, barring a deal, that's been something that's been hanging over the election, and it remains unresolved. And Japan continues to be hit by the auto tariffs as well, that are at 25%. And with a weakened domestic situation for Ishiba, things aren't looking very good for Japan as it heads into further negotiations with the US.
Bloomberg's North Asia Economics and Government editor Yuko Takeo there following the latest developments around the upper house elections. And we have more coming up on Japan. Moody's Analytics joins us to break down the economic outlook as trade tensions rise. And of course, we continue to get this political uncertainty as well with the government. Haidi.
Take a look at European futures as we get this trade uncertainty continuing to play out. We are hearing that there are plans by EU policymakers to prepare a retaliation plan as the US stance when it comes to tariffs seems to harden. Envoy is set to meet to formulate that strategy of measures to respond to a possible no-deal scenario ahead of that August 1st deadline. The US now seen to want a new universal tariff on EU goods higher than 10%, limited exemptions, according to people familiar with the matter. So we are seeing a little bit of downside after European stocks really managed to eke out a small weekly gain in the previous session. But of course, we've seen quite a lot of optimism when it comes to expectations domestically within Europe, with a lot of stock market momentum really seeking to, well, having seen this market outperform the US this year. We're seeing stocks Europe 600 at the moment trading at a 35% discount to the S&P 500 when it comes to forward PE valuations. But let's get some more when it comes to the trade front. Our news desk editor Jill Deesis is with us, and Jill, we know that anything could happen, right, in the coming days, and certainly before August 1st. But we are hearing that European policymakers are sort of preparing for worst-case scenarios.
Yes, that's right, Heidi. I mean, what this ultimately boils down to is that when it comes to the EU and, many other economies that are ultimately trying to negotiate trade deals with the U.S., there's this increasing feeling that Trump has really hardened his stance on what the U.S. would consider allowable. And so what you see in the case of the EU is they were slapped with a trade deal letter from Donald Trump installing tariffs of about 30%. So that's pretty far away from a baseline of 10% with some exemptions that they were ultimately hoping to get. What we're hearing now is that the number of exemptions that the Trump administration, that Washington is willing to ultimately allow the EU at this point, maybe some carve-outs specifically for aviation, maybe some medical products, just seems like an increasingly shrinking number of sectors that ultimately would be allowed here ahead of this August 1st deadline, which, of course, as we know, is very quickly approaching. When you take that in combination with all of the other tariffs that ultimately already exist that are impacting the EU and other economies that the Trump administration has implemented here, you're talking about, some of those sectoral tariffs on steel and aluminum. You're looking at other broad-level tariffs. I think it's something around 70% of goods I have down here that the EU estimates that U.S. duties already cover. So that's to the tune of about $442 billion U.S. dollars worth of goods here. So when it comes to the EU side, what they're ultimately preparing for here is the likelihood that any trade deal is going to fairly heavily favor the U.S., but then they also have to come up with some concept of how exactly they would how they would retaliate. So there's the bloc has already approved some potential tariffs on some goods, particularly ones targeting politically sensitive American states, some spirits, some poultry, motorcycles, those kinds of things. So there's some tariffs that are already in the work, but there is discussion about whether to sort of broaden things out and allow for a more fulsome retaliatory effort here.
How strong a united front is the European Union presenting against the United States? Because we've heard that some members want to activate one of its most strongest trading tools that's called the anti-coercion instrument.
Yes, that's right, Shery. So there is some discussion on that front. What that tool would allow them to do is ultimately to apply tariffs more broadly, or retaliatory measures more broadly there. So it would kind of enable these states these countries to ultimately have that more fulsome effort. Of course, that is the big difficulty here in terms of, do you get everybody sort of united on that particular front? I think that what this ultimately spells out for us, though, is that there's just such a limited window in which, the EU, again, and all of these other nations ultimately have to try to negotiate a deal with the United States. We've certainly seen in the case of other places. I mean, we were just talking about Japan a few minutes ago. We've seen this in the case of India, some other nations in Asia Pacific in particular that have tried to send trade envoys to the United States, trying to get negotiations done. But when you've got so many other countries that are ultimately trying to get something over the line, I think that it becomes really, really tricky in terms of how exactly, if you're the EU, you as a bloc ultimately try to negotiate some of these efforts.
Bloomberg's Jill Dacey's there with the latest on the EU-US trade negotiations. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching when it comes to S&P futures, as well as how the dollar index is tracking at the moment. We're seeing a little bit of softness there when it comes to tracking in the US dollar. Of course, we're watching the yen with a great interest, given the level of political uncertainty that's causing some interesting moves in the Japanese currency. We saw the yen strengthening after the election. Analysts saying that uncertainty obviously tends to at least initially favour the Japanese currency. At the moment, we're seeing a little bit of a pullback when it comes to the dollar, but mild gains for S&P futures. Well, Federal Reserve Governor Christopher Waller says it's important to look at 3-month and 6-month inflation readings to gauge the impact of tariffs. Waller told us that while delayed tariffs are one possibility, a continued wave of additional levies would pose a greater challenge.
Tariffs are a tax, and in public finance, you learn that you may levy a tax on a firm, but who bears the incidence or the burden of that tax? Can be a group of people or one person, not necessarily the firm. So this is what I've heard from a lot of firms. If there's a 10% tax, they'll force their suppliers to eat some of that cost. Workers may eat some of that cost in terms of less hiring and things like that. The firm will take it out of their profit margins. And then lastly, some of it will get passed on. And as I mentioned last night, I've heard this for months now. Like, the rule is 10%, it's roughly, rule of thumb is a third, a third, a third. Suppliers will eat a third, firms will eat a third, consumers are going to eat a third of that tariff. So if you eat a third of it and it's 10%, like I've been arguing, this is like 3/10 on the inflation rate for a few months, and that's it. And it'll persist if you do 12-month over 12-month. That base effect will not go away for a while, and then it'll just drop off a cliff. So that's why I've been arguing you want to look at like 3 months and 6 months to see if these tariff effects pop up and then go away. And so that's more critical than looking at 12 months.
Yes, but the way the president is putting these tariffs on might not match up with theory, Chris. The Smoot-Hawley tax was passed and came into effect on a certain date. The president is not yet put on most of these tariffs. They're in theory still coming, and we still haven't seen the Section 232 tariffs for the most part, the national defense tariffs that he wants to put on semiconductors and pharmaceuticals, etc. So if the process is stretched out, consumers could be hit by an ongoing series of tariff increases, and given what they've just been through, isn't there a danger that inflation psychology starts to seep in?
Well, that's exactly the point. All my examples, Ben, is if you put the 10% uniform tariff on and keep it roughly in that range, then what I've described is what will happen. If there's constantly a sequence of higher and higher and higher tariffs, then you are going to get this rolling potential impact on prices. That's true. If it's still just a question of delaying it, that doesn't change my argument. Whether you see the spike in July or it happens in June or August or September, when it happens is irrelevant for the economics. That's a non-starter of an argument. Firms could also just spread it out in smaller increments over several months. the total effect still ends up being the same. They just get there in a later fashion, and it'll be smaller amounts. So the bigger thing is if we just continually get another wave of tariffs, another wave of tariffs, another waves of tariffs, that's when things become more problematic, thinking about what's going to happen with inflation.
Federal Reserve Governor Christopher Waller speaking to Bloomberg's Mike McKee. Take a look at now some of the biggest earnings that we'll see this week. Alphabet and Tesla will kick off results for the Magnificent Seven on Wednesday. TD Cowen thinks that Alphabet's revenue could grow at its slowest pace in about 2 years, even as the ad spending on its Google search engine stayed resilient. Meanwhile, Tesla's self-driving offerings will come under renewed focus as investors seek more on the planned expansion of its driverless robo-taxi beyond its limited rollout in Texas. And here in Asia, South Korean chipmaker SK Hynix will report on Thursday. Analyst consensus is for a 63% jump in second quarter operating profit, while margins could be supported by robust average selling prices for memory chips. But the point is, Haidi, that we are now seeing really markets trying to get any positive news out of the earnings season to keep rallying. The S&P 500, in fact, finishing near record highs. It notched 7 record highs in the last 15 sessions, and the second quarter earnings season for the United States has been going pretty well. I mean, consumer sentiment is at a 5-month high, but the margin for error is really small. So if you disappoint in any way, you're going to get punished. The market penalizing results that fall short of expectations, but the most in nearly 3 years.
Yeah, it really is a sense that obviously this is a market that's seen by many to be priced to perfection or even beyond that. There's so many external risks in terms of the inflation outlook, the Fed outlook, the tariff outlook, some of the geopolitical worries there as well. So you said it, Shery, you know, if you've sort of outperformed, then maybe you get a little bit of a shrug at best. You could see that in the financials that we saw. The banks had blockbuster numbers last week, still failed to juice their shares, right? They've crushed second quarter earnings expectations. We saw an almost 95% beat rate in those companies, but stocks kind of saw pretty muted reactions. Investors were largely pricing in these results, and as you said it, the disappointments are going to be punished. We saw Netflix exceeding outlooks in every major metric. United, when it comes to the airlines, upbeat about travel demand, but investors were pretty kind of collectively giving a shrug to these results, right? Netflix, in fact, on Friday closing down over 5% despite the strong performance. So it does have this sense that all of the good news, Shery, is priced into the markets now, which kind of, you know, goes to this idea that are we still seeing complacency? Because when it comes to tariffs and trade, it still feels like investors are willing to expect that, you know, a best case scenario, or at least a not as bad case scenario, might emerge. This is Bloomberg.
Take a look at how currencies are trading at the moment. Japan away on holidays, but we're seeing the Japanese yen strengthening a little bit against the U.S. dollar. We are now expecting the ruling coalition to have lost its majority in the upper house elections on this weekend. We're also following the euro because of these ongoing trade negotiations with the United States. Sources now saying that envoys of the EU will need to get some measures to respond to a possible no-deal scenario. We're also watching the offshore yuan. We do get the loan prime rates today. China's commercial banks likely to have kept them unchanged. But let's discuss what's going on with the upper house election and what could happen with the Japanese government here, and bring in our next guest, who says the government hasn't done enough to address voter frustration when it comes to the ongoing cost of living crisis. With us now is Stefan Angrick, head of Japan economics at Moody's Analytics. Stefan, great to have you with us. Of course, for a time for Japan, decades, it was about bringing inflation to the economy. We finally have it, but of course, voters not happy.
Absolutely. First of all, thank you so much for having me. You're 100% right. The inflation Japan is seeing is inflation that's driven by a supply shock, is driven by a higher cost of energy, food, most of which are imported. It's not the kind of inflation that Japan wanted. It's not the good kind, for lack of a better word, right? It's not because of better growth, wage growth in particular. So the kind of inflation we're seeing is stretching household budgets. The electorate has been unhappy with that, and the government has mostly been throwing its hands up in the air and said, we can't really do anything about that. So to that extent, the the result that we got is not a surprise.
So we have seen the government try to throw utility subsidies at voters. We have seen opposition parties calling for a sales tax cut. When it comes to the health of the Japanese economy, what is the right way to go forward?
Yeah, it's a great question, because I don't think that either of these sorts of policies really goes to the core of what Japan is struggling with right now. The opposition mostly called for various kinds of consumption tax cuts, right? Those run the gamut from small cuts on the consumption tax for food to broad cuts on the consumption tax for everything. The government advocated for cash handouts, etc. But what the Japanese economy really needs is support for both the demand side and the supply side. The Japanese economy is now in a place where it gets more difficult to grow through exports because of the deteriorating trade environment, tariffs in the US, tariff threats from the US. So Japan will need to find a way to generate more homegrown demand, if you will, to grow going forward. And that requires both demand support and supply support. And that is not something we've seen from either the opposition or the government. So
domestic growth is going to be hard, though, given the structural and demographic situation that Japan has been in.
No, that is true. But there is space for the government to act, given the fact that we now have inflation, as Shery was noting. That has helped the government raise record amounts of tax revenue. In the last couple of years, tax revenue has constantly surpassed projections. So there is room to act. And the question then is, what do you spend money on? What's perhaps ironic about the election is that Prime Minister Ishiba dug his heels in and said he would absolutely not cut the consumption tax. But the kind of cash handouts that he's been advocating for, they don't actually spend all that much money. But they don't actually save all that much money compared to the more modest proposals for consumption tax cuts, but they don't get you a lot of bang for the buck. So it's just a less efficient way of spending money. So at the end of the day, you wouldn't really come away with better fiscal metrics. And that's, I think, what's at the heart of this debate. You can focus on the short term and say we're not going to do anything, but if you don't really support the economy, that's going to come around to bite you in the long run, because you end up throwing the baby out with the bathwater. You're not going to get the fiscal house in order unless the economy grows. And if you don't get that, that's just, doing it the other way around is just a non-starter, if that makes sense.
We did see inflation in June sort of easing, but sort of staying still elevated, right, comfortable levels. Are you confident that a virtuous cycle is sort of firmly in place? And do you worry about one of the elements being that, real wages as well as household confidence and spending still seems to be a gap when it comes to the surge in inflation or the progress being made in inflation and how that's impacting broader confidence?
Yeah. It's a great question. So we look for real wages to gradually pick up towards the end of the year as inflation slows and nominal pay gains get some better footing. But there's a real risk that that's not the scenario that will materialize at the end of the day. We're already starting to see some weakness in the monthly wage data coming out in Japan, like the monthly labor survey, right? Cash earnings, etc. Those are showing some weakness, and there's a real risk that next year's Shunto spring wage negotiations might give us a rather disappointing result on account of what's going on with U.S. trade negotiations, right? The U.S. just announced that they would raise tariffs on Japanese exports to 25% starting in the 1st of August. Now, that might not come to pass, but it's certainly a sign that the talks with the U.S. haven't really made a lot of progress and that they're not in a good place. So if wage gains next year are slow on account of that, that would be bad, and that would keep households where they are right now. It would push real wage gains into the distance, and it would mean that real growth would continue to stagnate.
And yet, would a trade deal this year in the next few months change the calculation completely for the Bank of Japan, given that other metrics are still strong?
Yes, is a good point. I think what matters for the Bank of Japan at the end of the day is what happens to inflation. Are they going to get the demand-driven inflation, the wage-driven inflation that they look for, as well as growth? And even though the tariff outlook matters, it matters for corporates, it matters for profitability, it matters for hiring, labor market conditions, the Japanese economy is a very large economy. So at the end of the day, what happens domestically dominates, right? So that brings us back to policy. Ishiba needs to deliver, right? He needs to pivot from being a prime minister that says no to being a prime minister that says go, right? He needs to do something for the economy. He needs to address cost of living concerns. If he gets that right, then he has a shot of staying in office. If he doesn't, I think there will be good reasons to be skeptical about his longevity.
How problematic is the Japanese yen, given that it's very much dictated by what the Fed does as well? And of course, a weaker yen doesn't help households. It helps some exporters, but that's also tricky, isn't it?
Yeah. Absolutely. It's a big part of the story. It's one reason why inflation in Japan is so sticky. So if the yen were to weaken again, that's another factor that might, trigger the BOJ, that might cause them to hike faster than expected. If it goes the other way, then it might push hikes into the distance as well. But it's a big part of the story. Now, we've seen the yen gain a little bit in early trading on Monday, as maybe the result wasn't quite as bad as markets had expected, right? But coming back to my point earlier, what matters in the long run is really how well the economy does. We've seen this in Europe after the US has started threatening tariffs on Europe. There was a pivot towards more fiscal spending on defense and infrastructure, and the euro has gained a lot of ground as a result. So there's really a difference here between the short run and the long run. Japan needs to focus on the economy. If you focus on the fiscal metrics before the economy, you're really putting the cart before the horse.
Stefan, Angrick, good to have you with us, head of Japan economics at Moody's Analytics. As Haidi, we're also going to get Tokyo CPI numbers later in the week on Friday, which will give us sort of a look at where national prices are going from here.
Shery, take a look at how we're tracking when it comes to trading here in Australia, extending that downside now when it comes to the stock session, down by 0.7%. This, though, after we saw another 1% gain on the Friday session to close at another record high. Really, the rebound that we saw last week, fresh records, all sectors finishing higher, financials in particular getting that tailwind. But, of course, we're seeing perhaps a little bit of a breather, a pullback today, off by over 0.5%. The Aussie dollar also giving up a little bit of ground, but still over that 65 US cent level. We do have the prime rate when it comes to China being looked at today. That's expected to hold steady. Watching still yields, but perhaps more on the longer end, given that we have had that global concerns when it comes to fiscal largesse really playing out mostly in sort of the markets, including treasuries and JGBs as well. But when it comes to Australia, tariffs are also front and centre, with the Australian Treasurer Jim Chalmers saying there's no chance that Australia's subsidies for certain drugs are up for negotiation, even as officials evaluate President Trump's threatened potential 200% tariffs on pharmaceutical imports. Chalmers spoke with Bloomberg from the G20 meetings in South Africa.
Well, Australia has the baseline tariff, the 10%, and some additional areas like steel and aluminium, copper, pharmaceuticals. And so we're engaging with our counterparts in the US, like almost every other country is in the world. We're pretty well placed and we're well prepared to deal with these tariffs. The direct impact is relatively manageable. Our bigger concern is the impact on global demand of all of this uncertainty and volatility and unpredictability, which puts global growth and indeed global inflation at risk. And so in our modelling, the bigger risk comes from the impact on the global economy rather than the direct impact.
Okay, because 10% is basically, as far as we can tell, the lowest possible deal. That's effectively what you will have with the United States. Are you happy with that, and does that warrant retaliation or no?
We've decided to go for resilience in our own economy rather than retaliation. You know, the 10% tariff is the lowest of any countries, but you know, we've made it really clear that we think the appropriate tariff consistent with our trade agreement is zero. We see these tariffs as self-defeating. We see them as an act of economic self-harm. We've made that very clear. Bad for the US economy, bad for the global economy, and therefore not good for Australia.
Do you see any progress possible on steel and aluminum?
Well, it remains to be seen. I mean, we've been engaged more or less constantly for some months now. Whether it's steel and aluminium or some of the more recent announcements around copper and pharmaceuticals. Our approach is to engage at every level as much as we can to get a better deal for our workers and our industries, our exporters, our and our investors. And that approach will continue to guide us.
And in terms of the negotiations around pharma, we've heard 200% as a possible figure from the United States. Are changes to Australia's pharmaceutical benefits scheme, is that something that's on the table because the Trump administration has been very focused on non-tariff barriers? Is that part of the conversation?
Absolutely zero chance. We couldn't be clearer. Our pharmaceutical benefits scheme is a crucial part of our architecture, our policy architecture. It's something we're very proud of. We've made it really clear that we're not prepared to negotiate or diminish or weaken the PBS in order to get a deal. We've been clear about that from the beginning. We're working through the potential consequences of pharmaceuticals being caught up in these escalating trade tensions. We do have quite a substantial export offering into the US when it comes to pharmaceuticals. But how this potential tariff might work, we're working through with the industry and with the administration.
There's been a huge amount of pressure from the United States for allies to spend more on defense. You saw that most concretely in NATO a couple of weeks ago, where you had that boost in pledges for 3.5% effectively of defense. Do you think Australia could get to that figure at 3.5%? Do you think that would be appropriate to join sort of allies at that level?
Well, first of all, it is a big part of the conversation here, particularly with European friends, how they'll find the 3.5% of GDP and how they'll account for the other 1.5% of GDP for national security related spending. For Australia, we are already by our standards, quite dramatically escalating our defence spending. We're taking it from 2% of GDP up to 2.3 at the start of the next decade. That already represents tens of billions of dollars in extra investment. It's a much higher trajectory than when we came to office 3 years ago. And so we are increasing our defence spending. We make those decisions, trading them off against all kinds of other budget priorities. But we say to American friends and we say to the world more broadly, we are already increasing our defence spending because we think it's important at a time where we are seeing this heightened uncertainty in the world.
Australian Treasurer Jim Chalmers speaking with our colleague Oliver Crook. We have more ahead on the Asia trade. This is Bloomberg.
Some stories we're tracking out of China for you, and private equity firm Blackstone has pulled out of a bid for a stake in TikTok's US operations. A source says the firm has offered its potential share to other investors in a consortium that includes Oracle, Andreessen Horowitz and General Atlantic. An ownership shift is needed to split TikTok from Chinese parent ByteDance ahead of a mid-September deadline. China is tightening controls on critical mineral exports, pledging zero tolerance for smuggling and illegal shipments. State broadcaster CCTV says Beijing's export control office flagged recent cases involving false declarations and transshipments through third countries. China is enforcing stricter licensing for all rare earth shipments amid ongoing trade tensions with the US. President Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit beginning at the end of October in South Korea. The South China Morning Post citing sources saying Trump could make a stop in China on his way, or they could meet on the summit sidelines. Sources have told Bloomberg that Trump has been dialing down his confrontational tone with China in hopes of securing a summit. Well, senior Chinese official says China's trade with the world is within reasonable bounds and the nation is not out to dominate global markets. Let's bring our China correspondent Min Min Lo and give us a context when it comes to this Bloomberg scoop. What was said?
Yes, this is said by the Chinese Vice Finance Minister Liao Min, and he essentially is saying that Chinese production is targeted at meeting the domestic demand. And yes, of course, if there is demand for Chinese exports, the exporters are going to sell them overseas. But the goal is not to dominate every single market out there. And he's really trying to counter Scott Bessent's accusation that China is one of the most imbalanced economies in the world. He said that the Chinese government has in fact been leading the charge in trying to transform the economy into a consumption-led one with rather balanced trade. And he said that there's been progress made. If you look at the last few years, consumption as a share of GDP growth has gone up to 56% on average in the last 4 years, which is 8 percentage points higher than the previous 4 years. And he says the government will continue to strengthen social safety net to create more jobs, improve the pension system, increase salaries so as to boost spending power in the long run. Now, bear in mind that Liao Min is one of the key members of the negotiating team that met with Scott Bessent and Howard Lutnick in London and Geneva. And these comments are coming just ahead of the expected meeting that will be taking place very soon to kick off the second round of trade negotiations between the two countries.
We have seen a lot of front-loading of exports, which of course have helped those trade figures coming from China. But how much can China's industrial sectors really survive if we continue to see this onslaught of tariffs?
Yes, so if you look at the figures, China's industrial profits last year was about 15% or so. And our Bloomberg economics team have found that only 5 out of the 33 sectors that they studied would be able to absorb the impact of the levies that are currently applied to them. Because you're looking at tariff levels on average of about 40% on Chinese goods versus industrial profits of around 15%, especially when it comes to some of the worst performing sectors in terms of profits. We're talking about things like stationery, furniture, textiles, the sort of low-value, high-volume goods that China exports. They're getting profits at the low teens, and they are going to likely face either bankruptcies at worst or lower profit margins at best. Some of the better-performing sectors include things like pharmaceuticals, extraction of oil and gas, mining of non-metals, but these sectors already are quite shielded from those tariffs because they are more domestic-facing ones. So when it comes to the export-oriented markets, sectors, the cushioning factor right now is that China actually sells a lot to many other countries besides the US. But longer term, if we see this shift of supply chain away from China, it's going to have implications on these firms if they cut salaries, cut jobs, impact on Chinese employment and growth in the longer run as well.
Bloomberg China correspondent Mimi Lo there with the latest on the Chinese economy. And these are some of the other stories that we're following at the moment. The South Korean government says days of torrential rain have left at least 17 people dead and 11 missing. The worst impact has been in the country's south, with heavy downpours causing landslides, flash floods, and collapsing houses. More than 2,700 people have been evacuated. President Lee Jae-myung is pledging support for affected areas now designated special disaster zones. Israel has warned it will move the first time into a town in the heart of the Gaza Strip that it had earlier skirted for fear of harming hostages. The military on Sunday told Palestinians in Deir al-Balah to evacuate southward. Hamas, meanwhile, says a total of almost 1,000 Palestinians have now been killed while waiting for aid, including 67 on Sunday when Israeli forces fired shells. Israel says its troops fired warning shots only. Iranian media reports say agreements been reached for talks on its nuclear program with the UK, France, and Germany. A state-run agency says the talks planned for Friday will be at Deputy Foreign Minister level. It says the discussions will be separate from indirect talks with the US, which have stalled since Israel launched attacks on Iran in June. Ukrainian President Volodymyr Zelensky says his government has proposed a meeting with Russia next week, more than a month after the previous round of direct talks. Zelensky says the Russian side should stop hiding from making decisions. A Kremlin spokesman, meanwhile, says a meeting between Presidents Putin and Trump will definitely happen, but that so far the right time has not come. We have more ahead. This is Bloomberg.
We're watching TSMC in the session. Of course, it's been a few days of milestones when it comes to this particular stock, and the breakthrough that we saw, particularly on Friday, closing at that record high, the market cap topping $1 trillion as of the Friday close, and now matching Berkshire Hathaway in terms of market cap. Still, though, TSMC has cited FX volatility as a major source of uncertainty affecting profit margins. That's after the Taiwanese dollar surged nearly 11% this year against the US dollar. CFO Wendell Huang told us exclusively that the chip maker is constantly reviewing its hedging strategies.
We don't predict the Taiwan dollar. We simply described the potential impact to us. And as I said, there are 6 factors affecting the profitabilities. Foreign exchange rate is something that we cannot control. But there were such instances before where the foreign exchange rate was not in our favor, but we managed to lean on other factors so that we are able to keep our profitability. And that's what we are planning to do.
Do you have contingency plans in place for a more rapid appreciation of the Taiwan dollar?
It goes back to what impact our profitabilities. So there are the factors that we're able to control, we will definitely work hard on those factors to maintain the profitability. We use different hedging alternatives. The first one is to just simply sell the US dollar in the market, spot market. And we also use forward contract. And we also move part of the cash, the US dollar cash, to a offshore holding company, which the financial statements are denominated in US dollar, not in NT. So that saves our hedging cost.
Which tool your priority, or is your priority?
It's a combination. At the same time, you want to sell the spot, which is the easiest one. But there is market appetite to consider. So you go to the forward contracts, still there's also market appetite and cost and hedging cost. And then we've been using this capital injection to the offshore company for years. So there's a combination, and we will use those combinations.
TSMC CFO Wendell Huang speaking exclusively with Bloomberg's Annabelle Jewelers. And take a look at YG Entertainment trading in South Korea right now, jumping as Blackpink's Jump, its new song, also is now topping charts. Remember, this is a comeback song after a 2-year hiatus for Blackpink. So we're watching YG Entertainment and how consequential that will be for the entertainment industry in South Korea. The China show is next. This is Bloomberg.